You're listening to the Falcon Method podcast, the audio content accompanying our monthly investment newsletter service. If you're new to the channel, our Falcon team is made up of die-hard value investors who are dedicated to helping you navigate the chaotic stock investment landscape. In this series, we provide regular updates on investment-related topics and recap highlights from our newsletter in a more casual format. Without further ado, let's jump into today's program. Welcome everyone for the second podcast session. We hope that you've enjoyed the first one, and now we're going to follow up on our previous topic, which was our investable universe. I'm Matt, and Pete is here with me also.
Hey everyone.
So in the first episode, we concluded that our investable universe consists of companies with an immaculate dividend history, because in aggregate, those tend to outperform the market. And now we will introduce the second step of our screening process, which helps to narrow down the pool of stocks even further from the roughly 400 survivors, which we had after the first screening criteria.
Now, just give you a bit of a background, what's our objective with our further filtering steps. So obviously we're looking for companies that could be an interesting investment candidate.
Yeah, so basically our goal is to decide among the dividend-paying companies which are the truly great companies that consistently create shareholder value. As we've said in the first episode, it's not a great dividend that makes a great company, it's rather the other way around. So that's what we're trying to screen for in the second step.
The basic characteristic of a company that makes a company great is its ability to create true shareholder value over the long run. That is, to outearn its cost of capital. And to do that, to identify such companies, we reach out to the EVA framework, where EVA, as we mentioned previously, stands for Economic Value Added.
Which is, according to our current best understanding, the absolute superior framework for analyzing such situations. So basically, when we analyze each company, we are looking at three dimensions. The first one is quality, the second one is growth, and the third one is valuation. So first of all, looking at the quality factors. When deciding whether a company is of immaculate quality, we are basically looking at factors like, first of all, return on invested capital, which we consider to be the most important financial metric in traditional accounting. But since we are conducting research in the EVA framework, we're also looking at EVA margins,
which is basically the EVA the company generates divided by its top line, by its sales figures.
I think in a later episode, we're going to elaborate more on why, for example, EVA margin is far superior to any other margin metric which we could get from a traditional financial statement, like, for example, operating margins or net margins.
And also it's the single most important metric to define whether a company has a moat that is a competitive advantage that is sustainable over the long run. So the EVA margin is the key factor to judge that.
It's basically such a comprehensive metric that it gives you a ton of information about the quality of a company. But basically, when we are trying to search for the truly outstanding candidates, quality alone is not enough to achieve outstanding investment performance in the long run, because a company must be able to deploy incremental capital into projects where it could profitably grow.
Yeah, basically incremental capital at high returns.
Yeah, the higher the better, but it must be above the cost of capital, as we are going to elaborate on that. So basically what we're trying to do is that we use a multi-score ranking system where roughly 50% is quality and the other 50% is growth, and we get a combined score, which we simply call our monster score. And we want to emphasize that this score does not consider valuation. So first of all, we are just trying to search for really the best companies that we could find on the market currently.
And obviously, without laying out the exact algorithm, we can give you the thought process behind that. And that is, we want to see companies rank in the top tier that are outstanding in both quality and growth terms.
Yeah, and we have to note that for both quality and growth, we are determining market averages. So we basically look at the S&P 500 and for example, we look, okay, what's the average return on capital the S&P 500 company makes? And when we are looking for possible candidates, we want to see that the particular company we're looking at is head and shoulders above the S&P 500, both in terms of quality and in terms of growth. Our key focus, of course, when we're looking at growth is growth in EVA because that's what matters the most. But we're also bringing in some qualitative decision here by looking at the top line, because the main source of growth for some companies is sometimes purely margin expansion. And since that is a finite story, we want to see sustainable growth in revenues.
The reason why we combine these two metrics, that is top line growth and growth in EVA, is because top line growth is not of much use without creating incremental economic value. And this is why you have to look at growth from both aspects in that case.
Just to give you some perspective, in our previous monthly newsletter, out of the 400 dividend payers that qualify in our investable universe, only 57 scored considerably higher marks, both in terms of quality and growth, than the S&P 500. So you can already see that these companies are far and few. And now I think we're going to touch upon valuation. So as we have mentioned, this monster core does not reflect valuation, which is of course problematic. So the reality is that many investors don't make the distinction between a great company and a great stock. That being said, when we look at these EVA monsters, we need to redefine how we look at valuation. And the reason for that is if a company is able to achieve remarkable, profitable growth over the long run, which is of course not only a quantitative but a qualitative decision which we have to make. But if that holds true for 10 or 20 years, it's really hard to overprice these companies based on short-term valuation multiples.
Yeah, one quote from Charlie Munger comes to mind at this stage, which says that over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years and you hold it for that 40 years, you're not going to make much different than a 6% return, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with a fine result.
Yes, so that's the framework in which we are analyzing these companies. I think it's important to mention that in the case of what Mr. Munger said, this only holds true if the reinvestment rate is 100%. Now, what does that mean? What we mean by that is that a company is able to deploy 100% of its internally generated free cash flow into projects which could earn, I think it was 18% over 20 or 30 years. Now that is, I would say, it looks good on paper. I don't believe there are many companies which are able to achieve that. So this 100% reinvestment rate at such high returns seems a bit unrealistic. But we were trying to shed light on the mathematical equation behind the process in which we analyze these companies. Just as an example, if we mention few of the best reinvestment mode companies, which can, of course, reinvest a significant portion of their free cash flows at immensely high returns, I can think of Facebook, Google, Microsoft, and their reinvestment rate, which we calculate by dividing capital expenditures in the cash flow statement by operating cash flow. So basically, we're trying to see how much the company spends on capital expenditures compared to how much cash flow it generates. I think those numbers are roughly in the neighborhood of 30 to 50%, which are very, very good.
Yeah, I think the moral of the story here is that in case of truly outstanding companies like EVA monsters, as mentioned before, it doesn't make much sense to overstress valuation, right? It's completely fine to compare it to the broader market because simply in quality and growth terms, they are head and shoulders above the average company in the S&P 500.
Yeah, so the focal point of our analysis is whether these companies are overpriced or not. Because if we find a great company, but it's trading at unjustifiable valuation levels, then we're not comfortable buying such a company, even if we could make a handsome return in 20 years if our qualitative assessment holds true. We haven't mentioned yet, but the main metric which we are looking at when we're analyzing the valuation of a company is the free cash flow yield, which is basically the trailing 12-month free cash flow divided by the market cap of the company. And we compare the free cash flow yields of our EVA monsters to the market average. It's interesting to note here that the free cash flow yield of the S&P 500 is at historical lows currently, below 3%, which means that the market is extremely stretched in terms of valuation. But if we find a company which has a similar free cash flow yield to the market and scores much higher on the quality and growth dimensions, then we have found a much better company at a similar price.
Yeah, at this stage, we must know that although this gives us a good yardstick in a way that we can compare the actual valuation of the EVA monsters to the broader market, but it's worth noting that what we've done so far is backward looking only. So we try to judge whether a company is truly outstanding in quality and growth terms, judging by its historical financial figures, that is, looking in the rear view mirror. But it's much more important to note that the way we invest is always through the windscreen.
Yeah, so we model each and every company that goes into the newsletter and of course much more. So in the case of EVA monsters, what we are trying to see is whether the fundamental return of the company is enough to offset a potential contraction in the valuation multiples. And if on a 5-year time horizon, what we're seeing is that if the valuation multiple reverts to a more, let's say, conservative level, and our total return would sink below double digits as a result, then we have a significant valuation risk in that company at the current price. So we would wait for a more attractive entry opportunity where the fundamental return of the company would not be dampened by mean reversion. And I think it's also important to understand that if we find a company which is head and shoulders above the market in terms of quality and growth, and also has a significantly higher free cash flow yield, aka much better valuation, well, these are true gems which we are constantly looking for. And if we find one, then we're quite comfortable with building a large position in it. But these occasions are extremely, extremely rare, especially in today's market conditions. So these usually happen either in case of a general market meltdown or in the case of significant company-specific risks, which temporarily compress the valuation multiples when the company falls out of favor of the market. But of course, when such situation appears, we must analyze, I would say, whether it's justifiable or not.
Yeah, basically if it's just a hiccup or really a life-threatening event for the company.
But still, if that quote from Mr. Munger would hold true, you could, in theory, pay a hefty multiple for a stock and still beat the market over the long run. And to showcase that this really holds true, we have brought you a study from Ash Park Capital. So just to recap quickly, they were looking at what kind of price-to-earnings ratios you could have paid for some companies and still beat the market over a 40-year time horizon. So the study is looking at the period from 1973 till 2019. So they were looking at the price-to-earnings ratios you could have paid in 1973 to achieve a 7% compound annual growth rate in terms of these companies, while the market returned 6.2% over the same 4 decades. So just to bring some examples, you could have paid a PE ratio of 281 for L'Oreal, a price-to-earnings ratio of 241 in case of Altria, the tobacco company, 129 for Hershey, 126 for Colgate. So really what we're trying to say here is that these multiples seem extremely stretched in absolute terms, but these companies have grown so much and were so high quality that these price-to-earnings ratios could have been justified.
Now this example also showcases quite astonishingly that it's really important to look at the quality and growth dimensions and do not overstress the valuation in light of these two metrics.
Yeah, I would rather say that if the quality and growth dimensions are and they remain extremely, extremely favorable over the long run, then the valuation is of less importance. Still, we're rigorously trying to find fairly valued or rather undervalued EVA monsters, but it's no easy job. So what I'm just trying to get through is that we're not completely forgetting about valuation, but we lay less emphasis when we're looking at the top 5 to 10% of our investable universe. And just as a closing thought, I think it's important to mention why we favor EVA monsters over the fallen angel type of stocks, which we're going to talk about in the next episode. The situation is that if you find a fairly valued or rather undervalued EVA monster, and your quantitative and qualitative assessment holds true over the long run, you can make very handsome double-digit returns. And what separates EVA monsters and fallen angels is that for an EVA monster, that handsome double-digit returns can really last 10 to 20 years or even more, while in the case of mean reversion fallen angel types of investments, we can still make extremely good returns, but that requires a much more active approach, since in 3-4 years our investment should play out, and once it does, we have really no incentive to stay in that position. So we're going to have to rotate and find another good investment opportunity. And if we're able to consistently find great investment opportunities to replace our previous ideas, then there is no problem with that. Of course, you're going to have to pay taxes, so that's one downside. But when you buy a truly great EVA monster, you can just buy the stock, sit back and relax and see your handsome returns come in for 20 years. So that's a much more passive approach. That's the true buy and hold approach instead of an active value investment, which is what we're going to talk about later.
Yeah, and just to add to that, in hindsight, it often reveals itself as a mistake to sell these type of companies. So the best thing you can do is really to hold on to them over the long run.
Yes, as long as the quality and the growth opportunities of the company is not drying up significantly, then you should hold the stock for as long as possible. So that was it for today, I think.
Yeah, thanks a lot for listening and see you next time.
Thanks and see you next time. Thanks a lot for listening. That concludes the most recent edition of the Falcon Method podcast. If you like this episode, please don't forget to hit the like button and subscribe to our channel to be notified of new releases. For a detailed analysis of our monthly top 10 most attractive stocks, you can start a free trial for our newsletter under the link in the description below and get a $40 discount off the standard annual subscription fee using the code TFMPodcast40. That is TFMPodcast40 at checkout. In the description below, you can find the link to our newsletter, as well as our Seeking Alpha author profile. Make sure to check them both. If you have any questions, feel free to contact us via the email address in the description. Thanks again, and see you next time. Please note that this material is intended for educational and entertainment purposes only, and it is not a personal recommendation to buy or sell any stock or to adopt any investment strategy. The value of your investments can rise as well as fall, and there's always a risk of permanent loss of capital. Past performance is not a reliable guide for future performance. The investments referred to may not be suitable for all investors, and you should always seek personal advice from a qualified financial advisor. We can only answer questions of general nature and are unable to provide specific buy or sell recommendations or specific investment advice on an individual basis. In terms of full disclosure, we or a connected party may have an interest in the securities mentioned,